Hello, everyone. Thanks for joining me. And today we're going to talk about something that can have a huge impact on your Shopify store, especially as we head into Q4. And today we're really going to dive into how to use Shopify's built-in metrics to make data-driven decisions that will fuel your growth, keep your cash flow healthy, and help you dominate during this busy seasons coming up. We'll be breaking down several key metrics, both ones you're familiar with and some you may not even considered yet. So each of these metrics provides a critical insight into your business's performance, and I'll show you how to track these metrics, interpret them, and turn them into actionable data. Whether you're looking to boost your sales, improve your conversion rates, manage your inventory, or increase customer retention, these insights are really going to help and guide you in the right direction. We want to make this Q4 your most profitable quarter yet. My name's Jacob Curtis. I'm a CPA and certified Profit First professional and a business coach. I started Curtis Accounting Solutions to remove the stress of doing the bookkeeping, the payroll, and taxes, and to provide practical business advice that really helps e-commerce stores piece together financial freedom. I'd love to hear your thoughts and questions on today's episode, so please leave a comment below and remember to like, share, follow, subscribe, all those fun things. Let's start by talking about revenue and revenue trends specifically. Now, Shopify gives you a real-time snapshot of your revenue on a daily, weekly, even monthly basis. But just looking at your revenue isn't enough. You need to really understand what's driving it. Are there certain days of the week or specific weeks of the month when your revenue really spikes? Maybe these are tied to promotional campaigns or product launches or something like that. Tracking revenue trends helps you to understand what works so you can replicate it in the coming months in Q4. For example, if you made $15,000 in November last year, but only $10,000 in October, what was the reason? Did you run a successful promotion during Black Friday, or maybe your holiday email campaigns were more effective? By identifying these trends, you can start planning for this Q4 and run targeted promotions to maximize revenue. So for example, let's say that last year you saw a revenue spike of $8,000 on Black Friday, but your revenue dropped sharply the week before. What could this tell you? Maybe your customers were waiting for the Black Friday sales and deals. So this year, what you could do is offer early bird promotions for customers who want to lock in those discounts before the big sale, ensuring you don't lose out on sales leading up to the event. Now, conversion rates measure how well your store is turning visitors into buyers. The average conversion rate for e-commerce stores is between 2 to 3%. If you're below that, it's time to dig in and to find out why. But even if you're performing well, small improvements here can lead to significant revenue increases. So let's say your current conversion rate is 2% and your store gets 50,000 visitors a month. That's 1,000 orders, right? 2% of 50,000 is 1,000 orders. If you increase that conversion rate by just 1%, that's an additional 500 orders. In other words, a small increase in conversion rate can generate thousands in additional revenue, and you didn't have to drive more traffic to achieve it. One of my clients had a conversion rate of 1.7% for their top products. By simplifying the checkout process, reducing the number of steps, and offering guest checkout, their conversion rate jumped up to 2.4%. And this resulted in a $15,000 increase in revenue in a single month. Another client optimized their product descriptions by adding more compelling product details and customer testimonials. Their conversion rate for those specific pages increased by almost 1%, which translated into over 100 additional orders in a 2-week period. So don't forget to review those conversion rates for individual products and landing pages. Certain products may convert much better than others, and understanding which pages are underperforming and which ones are performing well helps you focus your optimization efforts. A key lever for increasing revenue is your average order value, or AOV. Now, Shopify provides data that shows you how much the average customer is spending per transaction. Increasing this number is one of the easiest ways to boost your bottom line without needing to increase traffic. For example, if your current AOV is $60 and you increase it to $70 through upsells or bundles, you'll make more money from every single customer. Now, let's look at a few ideas and things that you can take to actually make that happen. So one simplistic tactic is to offer product bundles. If you're selling beauty products, for example, offer a set of complimentary items like a cleanser or a moisturizer at a discount. You're raising the perceived value for the customer while increasing their spend with you. Another example would be to set your free shipping threshold just above your AOV. Let's say it's currently at $55. So set your shipping threshold to $75 to encourage customers to add more items to their cart and their orders. I think you'll be surprised at how effective this can actually be. Customers are often willing to spend more to avoid paying for shipping. One of my clients just saw a jump in their AOV from $40 to $65 after implementing a tiered discount strategy, where the more items the customer added to their cart, the higher the discount they received. Now, this not only boosted sales, but it also increased the customer satisfaction as they felt that they were getting more value. Another one to look at is customer lifetime value, or CLV. This is a crucial metric for any Shopify store, or any store really, because customer lifetime value tells you how much revenue you can expect from a customer over the entire duration of their relationship with your business. This metric is especially important when deciding how much to spend on acquiring new customers. So let's say your average customer's lifetime value is $500, but it costs you $50 to acquire a customer. That's a solid return on investment. You're making 10 times what you spent on acquiring that customer. But if your CLV is only $150 and your acquisition cost is still $50, you'll need to rethink that strategy a little bit. Either increase retention or lower your acquisition costs. One way to increase your customer lifetime value is by implementing a loyalty program. A simple points-based system where customers earn rewards for every purchase can really boost repeat purchases and drive that engagement. Shopify integrates with a lot of different loyalty apps that make it easy to set up and track customer loyalty. One of my clients increased their customer lifetime value by 35% after introducing a loyalty program that offered a free product and exclusive discounts to repeat customers. Not only did this boost repeat sales, but it also created a sense of community and brand loyalty. Another critical metric is customer acquisition cost. We alluded to it just a minute ago. This metric tells you how much you spend on marketing to acquire a single customer. Knowing your CAC, or customer acquisition cost, is essential because it directly impacts your profitability. If you spend $50 to acquire a customer, but their lifetime value is only $75, your margins are going to be really, really tight. Ideally, you want your CLV to be 3 to 5 times your CAC to ensure long-term profitability. So a client of mine was spending $60 per customer, and most of that was on Facebook ads, but their customer lifetime value was only $100. By refining their ad targeting and optimizing their landing pages, they reduced that CAC down to $40 and instantly improved their profitability. Always compare your customer acquisition cost to your customer lifetime value. If your acquisition costs are eating into your margins, look at your marketing campaigns and optimize your targeting. You may need to tweak your audience or adjust your ad creative or explore more cost-effective channels if your ratios are a little off there. Inventory management is a delicate balancing act, especially when it happens in Q4 with the holidays. On the one hand, you want to have enough stock to meet demand, but on the other hand, overstocking can tie up cash and increase storage costs. Shopify's inventory tracking tools allow you to forecast demand based on past sales data, helping you to manage your stock and your inventory more efficiently. Let's say that you sold 1,000 units of your best-selling product last November, and you're expecting a 20% increase in sales this year. That would mean you would need at least 1,200 units on hand to meet that demand. But don't stop there. Think about any marketing campaigns you're planning on doing. If you are expecting a spike in sales due to new product launches or promotional campaign, you want to adjust your inventory levels accordingly. Run weekly reports to check on your inventory levels and compare that to your sales performance. Shopify's reporting tools allow you to track those in real time, helping you to avoid any kind of stockouts during those peak sales periods. Your traffic sources are key to understanding where your customers are coming from and which channels are most effective. Shopify tracks whether your traffic is coming from social media, search engines, or paid ads. But the important part is understanding which of those channels are actually driving conversions. If most of your sales are coming from organic search, but you're spending the bulk of your marketing budget on Facebook ads, you may want to reallocate some of that budget to SEO efforts instead. A client of mine was spending about 70% of their budget on Google ads, but was getting the majority of their sales from Instagram traffic. We shifted more of their budget to social media marketing, which increased their overall ROI on marketing by 30%. So review your traffic sources regularly, especially during Q4. The key is to optimize your marketing spend by focusing on the channels that deliver the highest return. As you prepare for Q4, it's critical to set clear goals. Whether it's revenue, conversion rates, or AOV, having a target in mind gives you a clear path forward. But don't stop there. Track your performance in real time using Shopify's tools. If you see a dip in sales or in conversions, you'll need to adjust your strategy pretty quickly. If your conversion rate dips halfway through November, consider running a limited time offer to boost sales back up before Black Friday. Being responsive to the data allows you to stay agile and make the most out of Q4. As we wrap up, just remember, Shopify really does give you all the data you need to make informed decisions, from revenue trends and conversion rates to client lifetime value or customer lifetime value to customer acquisition cost. All of these metrics are your roadmap to success. Don't make guesses. Let the data guide your actions, especially during Q4 when every decision really does count. So if you have any questions or need assistance with managing your company's finances, don't hesitate to reach out to me. I'm here to help you piece together financial freedom. Schedule a call with me to get started by scanning the QR code on the screen or going to jacobcurtiscpa.com/5-strategies-calendar, or just click the pinned comment and we'll get started. Remember to follow me, Jacob Curtis, and Curtis Accounting Solutions on Facebook, Instagram, Pinterest, and YouTube. Thanks for watching, and we'll talk to you soon.